Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. There is a lot going on in markets, and we're going to try and cover a lot of it today. We have a couple of community questions on emerging market ETFs, so we're going to talk about the best way to invest there. It's investor letter season. Every quarter we get letters from some of the best investors around the world. We've got two of America's best investors who have opposing views on where to from here. So we're going to look at what they think and how they're investing as a result. But first of all, as we always do, we're going to start with the news of the day.
News and markets.
All right, Bryce, well, news.
Yes.
There's a lot going on.
There is.
There is the US elections less than a week away. We have Australian billionaires falling left, right, and center, tax evasion, cheating scandals, the like. We've got uranium miners falling 20% plus. We've got the AI story playing out. What else have we got? We've got ANU going bankrupt. Almost going bankrupt. We got the Prime Minister getting dragged into more Qantas-related scandals. There's a lot going on.
There is.
And I think maybe we start this conversation by taking a breath and asking the most important question. How much do you think the ASX 200 is up in the past 12 months?
20%.
Yeah, 21%.
Yeah.
How much do you think the S&P 500 is up in the past 12 months?
36.
Close, 39%.
Yeah.
So we can all just take a break, take a breath. And as we get into the news, remember to not be overwhelmed by the news.
Well, why do we do a news section then?
Because
why do we do a daily news email?
Short-term media incentives don't align with long-term investing.
Yes, that's right. If you were invested in some of those companies, though, you should be paying attention.
Definitely. No,
Yeah, like we've spoken about, facts have changed actually since we last spoke about Chris Ellison and old mate Richard White.
Yeah, well, what changed?
Well, Richard White has now, he stepped down as CEO.
Yeah.
He quit and is now resumed with the title founding CEO and is a long-term consultant.
To be clear, he stepped down as CEO and he's been rehired on his same salary, $1 million a year as a full-time consultant. Yeah. Also still owns 37% of the company.
Yeah.
So
I think it'll get messy. I think it'll get messy there. And since we last spoke about MinRes, ASIC have now started really sniffing around, and the board have slightly now changed their tune a bit. Seems like they're backing away from backing Chris as fervently as they were a week ago. So if you are invested in those, you should
definitely
pay a bit of attention.
Definitely. Yeah,
yes. But longer term, you're right.
Yeah, I think if you're invested in individual companies, you need to be paying attention. If you are just interested, like we are, it's interesting to pay attention.
Yeah.
But we do multiple news segments a week on this podcast. We do a daily news email, but I can assure you that I don't make investment decisions day to day based on the headlines.
No.
Yeah.
You missed one thing though, Ren, and that's Bitcoin's about to break 70K.
Yes. Yeah. Well,
as we run into the election,
it's been flirting with that. It's in the high 60s US dollars, but it's good. It's good.
Yes, but those are not the stories that we wanted to talk about today.
No.
We wanted to talk about two stories that are pretty cooked over in America, in our view.
Yes. Headline: America is cooked.
Yes.
Brackets, not the election.
Not the election, yeah. So two headlines. The New York Stock Exchange want to extend trading hours to 22 hours a day.
Yes.
And Robinhood are now entering into the contract betting market.
Into gambling.
So let's start with the New York Stock Exchange. They want to move to 22 hours a day.
Yeah, and we should be clear because I think this has been getting a little bit confused in its reporting. It's after hours trading.
Yes.
So right now, the New York Stock Exchange is open during the working day, sort of, 10 to 4?
So its core is 9:30 to 4.
Yeah.
That's core.
But then there's after hours trading that happens on either side of that.
Yeah, so they do 4 till 9:30 a.m.
Yeah.
And 4 till 8 p.m.
Yeah.
Yeah.
And the in-hours and after-hours distinction is a bit of a funny one, isn't it? Because you're still trading either one.
Yes, you're still trading either one. I know on Stake, for example, one of their tiers is you can trade, you can get access to after hours trading. I think all it's doing is actually giving you access to a separate electronic trading system that the core doesn't run on.
Okay. And so all that the New York Stock Exchange are doing in this story is expanding that 16-hour window to 22 hours. It's less of a big change, I guess, but it's also just like it just feels unnecessary.
Unnecessary. You'd hate to be an equities trader.
They're going to make more money from it.
Definitely.
Yeah.
A junior equities trader would be quivering in their boots seeing this headline, because now it's just going to mean that you're going to have to be on 22 hours of the day.
Just brutal, just so brutal. And yeah, there's talk of a Texas stock exchange that I think a private equity player is trying to build down in Texas. I think there's chat that they want to run 24 hours a day. I think a lot of what they're responding to is crypto markets being 24/7.
Yes, yeah.
But it's just like, guys, we don't need this.
Well, the New York Stock Exchange say that they're getting an incredible amount of demand from a lot of the people that are trading on the platform to go to 22 hours, 5 days a week. I feel like what you said is probably the driver. They're going to make more money from it. I would hate to see the day that they start extending this to the weekends as well.
I know. I think there's a stock exchange somewhere. I can't remember where it is. Maybe in Europe somewhere, but it opens like once a week or once a month or something like that.
That would be nice.
I like that. Like price discovery, then everyone goes away and just works for a week.
Yeah.
Price discovery at one point, then everyone, Anyway, separate conversation. Let's talk about how another way in which American investing culture is going in the wrong direction, and that is one of their premier investment apps, probably the biggest investment app amongst young American investors, is now embracing betting.
Yes, Robinhood came to prominence through COVID. Well, not came to prominence, but really took off during COVID. Are now offering contract bets.
Yes.
And this is where they fix the odds effectively. Unlike a betting app where odds move depending on, is it demand that drives odds?
Yeah.
Yeah, depending on demand, they set the contract.
It starts with they
set the odds.
Bookies set it, and then it moves with money going in. So they've started with the US election. A week out, they announced that they're offering contracts on both Kamala and Donald Trump. Each contract you can buy for 51 cents. If they win, you get $1 back. Now, for the keen bettors out there, they will quickly realize that those odds are actually worse than you'd get from a bookie. Well, I mean, the Trump odds these days are better.
Right.
But you'd get better Kamala odds from a bookie.
Right, yes.
But I think it's pretty disappointing in my mind. And like, this is part of a broader sweep of prediction market legalization that we've seen in the US over the past month, 2 months. But you just don't want an investing app to also be the place where you punt on events.
No. The messaging that it sends is just, it's wrong.
Yeah.
Flat out wrong, and you're bringing two environments that should never be put next to each other together.
Yeah, and you're conflating the behavior of punting with long-term investing.
Yeah, exactly.
Yeah.
So America's cooked is the conclusion
America
here.
is cooked. Thankfully, we're in Australia. Sorry to our growing US audience, especially on YouTube.
Yes, if you are interested in headlines though, and want to stay up to date with everything that's going on around the world, make sure you signed up to our daily newsletter. There's going to be a link in the show notes. We'll send you the key headlines so you can remain interested, but not necessarily have to act on that on your investing journey.
Yeah, you can stay abreast of the news, so when there is something that you should act on, like it affects your company, you'll be aware.
That's it.
But don't respond to every headline. You'll do yourself in, especially now that you can trade 22 hours a day.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
As always, we love hearing questions from the community, and we have 2 questions today that are about emerging markets. And just a reminder, if you want to leave us a voice note, there'll be a link in the show notes to do so. But Ren, what have we got?
So the first question is from Amar.
Hey mates, just wanted to get your perspective on emerging market ETFs. Right now, I'm just investing in two ETFs, VAS and IVV, and just kind of dumping my money into there every fortnight, basically. And I was just wondering, because I'm looking at diversification, but whether emerging markets make sense to add to a portfolio. I feel like the general consensus is that long term, the growth just isn't there. Most of the countries are very unstable, very volatile. But on the other hand, I just feel like that, considering the size of the countries, of the economies, and stuff like that, that it's so hard to ignore as well. I just wanted to get your perspective on, do they have a place in a portfolio? Are they necessary? And what do you think of them? Yeah, thank you. Love the show.
Good question. Next one, though, is from Steve. Is that right?
Yes, that's
Nice.
Hi, Bryce. Hi, Ren. Love your work, guys. Just considering in diversifying into emerging markets and wondering what your thoughts were on putting VGE into your portfolio just as a satellite, just for some extra diversification. It's a bit dear at 0.48 basis points for their fees. And I'm just wondering, with nearly 6,000 holdings, is over-diversification a problem? What's your thoughts?
Wow, two solid questions.
Yeah.
From, thank you to Amar and Steve. And as I said, if you want to leave us a question, there's a link in the show notes. A lot to unpack there.
Yes.
So let's work our way through it. Emerging markets.
Yeah. And specifically emerging market indexes.
ETFs, yeah.
No,
or
no,
indexes.
indexes.
Yes,
Yeah.
yes.
So let's start with the conventional wisdom, which was that emerging market indexes, where you market cap weight companies from the largest company to the smallest company, and you just buy that index. Emerging market indexes were not seen as a great place to be.
Yeah.
Now, why is that? The top of those indexes were generally slow-growing industrial companies, often with like pretty strong ties to government, sometimes quite reliant on government contracts or government largesse, depending on the country we're talking about. And the exciting elements of emerging markets, those faster growing consumer companies or technology companies, were much further down the index. Or most importantly, and this was the really important thing, most importantly, some of those technology companies were listed in other countries entirely. So, for example, Africa's Jumia, not listed on an African stock exchange.
Yeah.
Mercado Libre in South America, listed in the US,
Yeah.
not listed in a South American stock exchange. C Limited, the Southeast Asian super app, not listed in Southeast Asia. All three of those companies are listed in the US. So if you were to invest in one of those regional indexes, trying to get exposure to those companies, you actually wouldn't have got them at all.
Yeah.
So that was the traditional view.
Yes.
That emerging market indexes were not filled with the companies that excited you about emerging markets, and they weren't a great place to be.
Yeah. Then the flow from that then logically was, if you want to make an investment into emerging markets and small caps, active management is probably the way to go. Taking the index for all those reasons is not right. However, times are changing, Ren.
Times are
Times
slowly
are
changing.
Those tech companies that were traditionally found themselves in the bottom of these indexes, they're now finding themselves at the top.
Yeah. The first example we have here is the Hang Seng, which is not really an emerging market index. It's the Hong Kong index. But
exposed to emerging economies.
To be honest, if you look at the CSI 300, which is like the mainland China 300 biggest companies,
massive.
It's just a story of pretty boring and uninspiring companies at the top of it.
Right.
Which proves the point around emerging market indexes.
Yeah.
The Hang Seng is now where a lot of China's technology companies sit. Meituan is the biggest, Alibaba, Tencent. Side note, not the point of this segment, but it's crazy that Meituan, which is like the food delivery app, is now bigger than Tencent, which owns the super app which Meituan was built on. Like it was built on WeChat.
I've completely lost track of Tencent, where it's at.
It's
up 41% year to last 12 months.
Yeah, it's still a pretty incredible company, but
anyway,
not the point.
Side note.
If we look at India,
Yep.
So Reliance is the second largest company. Infosys is the fourth largest. Reliance is a funny one because it was an example of a slow-growing industrial company, but now it's like super exposed to all the technology story that's unfolding in India with Reliance Jio. And if some of these companies are not super familiar, don't worry about it because we'll get to a point eventually. But I think Steve asked about VGE, the Vanguard Emerging Markets ETF.
Yeah.
And if you look at VGE, some of the top holdings, tell me if these names excite you. Taiwan Semiconductors, Tencent, Alibaba, Meituan, Reliance in India, HDFC Bank in India, Pinduoduo, which is the owner of Temu, for people who are unfamiliar. Infosys, Hon Hai Precision Industry, which people may know as Foxconn, the company that makes iPhones for Apple, and then China Construction Bank. So that's the top 10 in VGE. And there's some pretty exciting companies there. Technology companies, semiconductor makers, electronics makers, like...
Didn't know that Pinduoduo owned Temu.
Yeah.
I hate Temu.
You hate it?
I hate going on the app.
To be honest, I have a theory about Temu, which is like it's super problematic, but people are slowly going to keep using it because it's just so cheap.
Well, yeah. But gosh, it's annoying going on there. Anyway, that's another side note.
So you look at VGE and you say, okay, well, maybe some of that traditional view of emerging market ETFs no longer applies. Maybe there are more interesting and exciting companies sitting in the top of these indexes.
There might be, but I think the second part to Amar's question is the more interesting / worthy of discussion, which is the risks that come with it and the performance.
Yes. There are a number of risks, and there's the currency risk. So like a lot of these emerging markets, generally their currencies underperform the US or just more developed market currencies. And unfortunately, the investments are priced in local currencies. There's geopolitical risk, always governance risk and sovereign risk, especially with China. If you think about a couple of years ago where China just took a massive whack at the tech industry because they didn't think it was in line with sort of China's social values. There's concentration risk these days. Emerging market indexes are dominated by China and India. But I think the biggest risk of all, and the risk that Amar was alluding to, is underperformance.
Yes. So Steve spoke about VGA, the Vanguard Emerging Markets. Over the past 10 years, it's done 5.85% per annum. Now, if you compare that to IVV, which is the S&P 500, that's 13.34% per annum, so more than double. IOZ here in Australia is 8.76% per annum over the last 10 years. Pretty significant underperformance versus, I guess, where else you could be putting your money.
Yeah, and you're getting worse performance for more risk. Like emerging market economies are generally riskier. And I think the important thing to stress is where we started this conversation is people generally say if you want to invest in emerging markets, you need to think active.
Yeah.
But if we look at ASX listed active ETFs that invest in emerging markets, the story isn't a lot better. So Fidelity Global Emerging Market has beaten the index. It's done 8.5% per annum since inception in 2018. So that's done meaningfully better than Vanguard's Emerging Markets Index. And BetaShares also have an active Emerging Markets ETF, the Martin Curie Emerging Markets Fund. Since inception in 2019, 4.9% per annum.
Yeah. So underperformance.
Yeah.
Yeah.
So I think if you want to invest in emerging markets, you have to believe that that level of underperformance is going to change. Because I would just argue otherwise. Like you're taking more risk, you're getting worse performance. What are you doing?
Yeah. Well, neither of us have either an index or a managed fund that give us exposure to emerging markets. And for me,
are you not in the Nifty 50 ETF?
No.
Yeah.
No. For me, that's different though. I think about that differently.
India is an emerging market.
I know. I don't know why, but yeah, I don't have exposure to it.
Yeah, but I feel like that's the interesting thing as well. It's like, so India and China dominate the emerging market index, but the emerging market index has massively underperformed just investing in India, and that's because China has been an underperformer.
So I think to your point, Ren, around you need to believe that it will outperform. I think why I think India, I separate India from the conversation we just had is because I do believe that it has potential to outperform that 8% per annum. If you even look at the last 12 months, it's up 27%.
Yeah. So I guess then in that instance, you would say invest in India, don't invest in emerging markets broadly defined.
Yeah.
But look, there's nothing wrong with investing in emerging markets. We should be very clear. It provides diversification to your portfolio. It will pick up some of these more interesting companies that now top the index. That might change, but how I would think about it is going in eyes wide open about its historic underperformance, and I would need to be have some level of a conviction that that would change. And I would be thinking about it like a satellite position. I wouldn't be buying it, putting it in a bottom drawer and not looking at it again. Just because I don't think, for all the reasons we touched on, I just don't think that's how you should think about it.
Yeah. Well, thanks for the questions, Steve and Amar. As I said, make sure you leave a voice note if you would like to get a question on the show, and we'll make sure that we get it on and answer it.
A cheat sheet is a quick reference guide or concise summary of important information.
Welcome back to Equity Mates. This segment is called Cheat Sheet, where we look under the hood at some of the world's best investors and what they are investing in. But today, it is investor letter time. Q3 investor letters are now starting to come through. If you're just new to the show, investor letters are a treasure trove of information where they take the time to write to their shareholder base about what they've been up to for the last quarter.
Yep.
And we have a couple of letters here from 2 billionaire investors.
Yeah, so we wanted to pull them out because we think they give quite interesting, different perspectives on where the market is and where it might go from here. So do you want the good news or the bad news first?
Let's start with the bad news.
The bad news.
Yes.
So in the quote-unquote bad news corner is David Einhorn.
Dun, dun.
People may remember him as a quite famous short of Tesla for a long time, quite famously wrong short.
Yeah.
But David Einhorn is a billionaire. He runs Greenlight Capital. And here is what he said. Excuse the jargon here. We'll read the quote that we've pulled out, and then maybe, Bryce, you translate it. So here's the quote. We will avoid calling this market a bubble and simply observe that the dividend yield is low and the PE ratio is elevated despite corporate earnings being cyclically high, if not top of cycle. This time, it is not just a handful of high-profile technology companies with nosebleed valuations. In fact, it is easy to find mature industrial businesses with cyclical exposure and growth prospects that aren't materially better than the current nominal GDP growth rate that currently trade for 30 to 50 times earnings. So, Bryce, what's he saying there?
Long story short, he's saying he thinks the market is very overvalued,
Yes.
and that valuation doesn't just sit at the top where you would traditionally see it with all the big tech companies. He sees it market wide.
Yes. So that's in one corner of the debate, we have billionaire David Einhorn and Greenlight Capital
Punching
saying
away.
the market is overvalued.
Hot. I think he says in there it's the most expensive stock market that they've seen in a long time.
Now, on the other side of this debate, we have Daniel Loeb, who really shot to prominence around the GFC, made a lot of money around there. He is also a billionaire. He runs Third Point Capital, also quite famous for some scathing activist investor letters in his time. But that's not what he wrote about today. Here is his quote from his latest investor letter. Thankfully to Daniel and the team at Third Point, less jargon.
Less jargon, yeah.
Full credit.
Yeah. I respect, sorry to interrupt you, just about to fly into it. I like when I have a view that the less jargon in there, the better the investor.
Yeah.
Far away.
Okay.
Sorry.
Quote, in the economy, we see no evidence of recession, slowing inflation, and a real interest rate that still needs to come down. We believe healthy consumer spending and active levels of individual investing should provide a liquidity backdrop to sustain market levels.
I mean, that doesn't really need much unpacking. It was very clear. They're a lot more bullish.
Well, I think the key thing is that sustained market levels.
Yeah.
They don't think there's going to be a sell-off based on valuation or anything like that.
Yeah.
So, 2 billionaires, 2 very successful investors in their own rights, opposing views on where the market is and where to from here.
Yes.
Who is right?
I mean, this is the beauty of markets. No one's going to be like.
Well, someone will be right.
Someone will be right, but
I think the beauty of markets
no one knows.
is, for me, the beauty of markets is one of them will be right, but both of them will make money.
You reckon?
That's deep. Yeah, I think so. I think at our live show in Brisbane, we made the point that there's no one right way to make money. That like a lot of people make a lot of money, different times, different styles, different amounts, obviously. But I think that's something that I'm really learning.
Yeah, but let's put it this way. I got the impression that Einhorn he spoke a lot about Buffett's approach and why he's the best investor and how in fact he's probably been one of the best market timers in our generation or in history.
Buffett famously known for not timing the market.
Yeah. Well, he's arguing, Einhorn's arguing that in fact he's probably is one of the best timers of market.
Okay.
And looks at how he is approaching the market at the moment, not putting any cash in,
Yeah.
doing share buybacks and sitting on a shitload of cash.
Yeah.
And so Einhorn, I mean, is suggesting that he's doing the same.
Yeah.
So if he's not investing, he might not be making that much money.
No, well, this is the thing. So the great thing about all these big US funds is we can see what they own.
Nice.
Also, Einhorn has to invest. Like you're
Yeah.
given money by institutions and pension funds to invest.
Yes.
You have to stay invested. It's
Yeah,
just what
yeah,
you
yeah.
invest in. So let's go to what they own. And we've had a look on Ticker, ticker.com/equitymates if you want to use their tool to see what the best investors own. So let's start with the positive case. Let's start with Daniel Loeb. So if you believe that the economy is strong, the consumer is strong, and that the market can sustain its current levels,
Yeah.
what are you buying?
I'm all in on big tech, baby.
All in on big tech. And unsurprisingly, third point is pretty all in on big tech. So their biggest position is Amazon, 11% of the portfolio. Third biggest position is Microsoft. Fourth, Meta. Sixth, Apple. And eighth, Google. Oh, actually, for completeness, Taiwan Semiconductor is ninth. So what? That's 6 of the magnificent 7 tech
Yeah.
companies in their top 10.
His portfolio reflects his sentiment, that's for sure.
Interestingly, Nvidia not in.
No, he's got Taiwan Semiconductor in there. Yeah, no Nvidia. Too expensive.
Maybe.
Yeah.
Now the second biggest holding. So this is a little bit of a tangent, but PG&E,
Energy?
Pacific Gas and Energy.
Yeah.
It's like a California-based utility, quite exposed to the nuclear story that's playing out. So that is one to keep an eye on if you're interested in the nuclear story.
So that's the top 10. Anything else in here that... So he's significantly dropped his holdings in Bath and Body Works. I remember we had a guy come on and speak about that a couple of years ago. Yeah, Bath and Body Works. He sold about 33% of that. Uber's in there. Live Nation, very controversial. And Apollo.
Yeah.
Private equity. So a couple of well-known names in there.
Yeah. Two others that stand out for me. So Intercontinental Exchange is the owner of the New York Stock Exchange, which is always spoken about as just like a really high quality name. But one that is often not spoken about as a high quality name, a business that seems to be in structural decline and yet remains in this portfolio, Cinemark Holdings. It's a big cinema operator.
Maybe you think cinemas are back.
Well, let me tell you how
Consumer.
Cinemark Holdings has done over the past 12 months. Up 80%.
Oh, wow.
Yeah, so full credit to them. I mean, if you zoom out over the past 5 years, they're still down 20%.
Wow. Yeah. Post-COVID.
Yeah. And just like cinemas are in
broadly.
structural decline.
Yeah.
But I thought that was an interesting one. If we put a line through Daniel Loeb and tie it all up, in his investor letter, you can sort of see his outlook, and then you look at his portfolio and you see that the reflection of that outlook in a lot of the growthier names that he owns.
Yeah.
So that's one side of the story. Let's go back to the other side of the story. Let's go and close this out with David Einhorn. He was much more worried about current market valuations. How does he invest on the back of that?
So 32% of his portfolio is in a company called Green Brick Partners.
Yeah.
Now, Green
Property
Brick
developer.
Partners, are diversified home building and land development company, acquiring and building homes.
Yes.
So bullish on property, you could say. But outside of that, no big tech names in here. So his top 5 names: Green Brick, Console Energy, Bright House Financial, HP, and Kyndryl Holdings. So some more unknown names there. And then Penn Entertainment comes in at number 6.
I like to read these letters as they come out. And one thing that you learn is that David Einhorn, if you look back over his letters, he's been pretty bullish about Green Brick for a while. It's up 100% over the past 12 months, so it's not done too poorly. But I think this is a real story of like when you find a company that you have conviction on, hold it for a long time and hold a lot of it, and he has done that here. You know, it's more than 30% of his fund. So I think
that's after selling 10% as well.
Yeah. So I think that's just a lesson of conviction, staying the course. If your thesis is holding and you think you're onto a winner, you don't get many big winners in your time. I don't know how big a winner this has been for him, to be honest. Like, if you zoom out 5 years, it's 650% up. So he would have done all right on it. But that's just something, it's always at the top of his ledder and always at the top of his list. A couple of other names that stand out for me. Peloton.
Yes.
Surprising. That's he would own that as a turnaround story, I imagine.
Liberty Global.
And a company that has come up a little bit recently is Capri Holdings.
Yeah.
Now, this was a merger of a few of the luxury brands over in the US.
Yeah.
And they see it as like America's response to, you know, like the LVMHs of the world, the American luxury conglomerate. It's new as a merged entity, but it's an interesting company to see how it emerges from here. Somehow American luxury doesn't stand out to me in the same way that European luxury does.
But it does keep popping up amongst a lot of these big investors, so definitely one to watch.
I think one other observation, 2% of his portfolio is in a gold ETF.
Yes, yeah. Well, that brings us to the end of Cheat Sheet. As we said, investor letters are an amazing resource to get free insight into some of the minds of the best investors around the world. We'll include a link in our show notes to both of those letters. But there's also a great, aggregation on Reddit that you can have a look at, which we'll also put a link in. That brings us to the end of today's episode. Thank you for listening. As always, please, if you could leave us a rating and a review right now on your iPod app, it'll take you less than 2 minutes. We would really appreciate it.
iPod app.
Jeez,
that's old school. YouTube, Apple Podcasts, Spotify, wherever you're listening, please give us a rating and review. And Bryce will be back with his iPod next time.
I love it.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.